I recently talked about how you can work out a safe level of withdrawal from different size funds in retirement, which is a really good place to start if you want to get an idea of how much is enough to retire. But in that video, I talked a lot about the sequence of returns from your investments being a major consideration when you initially retire and how that might impact on your planning. We never know whether markets are going to be kind and go up in the short term or whether they're going to go down, but most of us have a fixed timescale for when we want to retire. And it's disconcerting not knowing whether that will be a good time to do so or not. So is there a strategy out there to help you benefit from gains when things go well, but stabilise your income when they don't, in order to give you the confidence you need to plan ahead and retire when you want to? Well, that is what I'm going to be discussing with you in this video. We'll first look at the ways that 99% of people take their withdrawals, of which there are generally two, and the big problems with both of those. As usual, I'm then going to draw on historic data and forward-looking projections to explain a method to you that has proven to provide a higher and more stable income in the long run than both of those methods. The aim is that by the end of this video, you'll not only be able to work out how much of a retirement pot you'll need, but you'll have a process to maximise your income responsively. If you're here for the first time, I'm Chris Bourne. I'm a UK-based financial planner, and I specialise in helping people achieve tax-efficient financial independence. I make videos to help you understand how to do that yourself. So if that's what you're looking for and you haven't already, feel free to subscribe and turn on your notifications. With all that said, let's get into it. I talked about the much lauded 4% rule in my last video and why it could fail more often than people may think. But whether it's 4%, 3%, 5% or any other figure that you choose to take, that type of withdrawal is probably the most common way that people take money out of their pension or other investments in retirement. It's what's called a pound plus inflation approach. Quite simply, pound plus inflation is where you choose an initial withdrawal level and increase that level by the prevailing rate of inflation every year. The real positive thing about that approach is that it ensures your spending is totally unaffected by market performance. So you have a stable amount each year in order to plan your expenditure. There is a downside though. Can you guess what it is? Well, if you said there's a risk my pot might run out during my lifetime, you'd be right. There's always a risk of this with a pound plus inflation withdrawal strategy, particularly if your investments get off to a very bad start. Imagine having just retired and an event like one of these happening, where there's a synchronized fall in the major asset classes. Not ideal when you've just started to take income. The other common withdrawal strategy people often use is what's called a percentage of value or percentage of portfolio approach. With this strategy, instead of starting off with an initial income figure which increases every year with inflation, people just take a percentage of the value of their portfolio at the end of each full year. The advantage of this method is that the portfolio will never run out during your lifetime. The big downside though is that your income will be highly variable from year to year, which will make it difficult to plan expenditure effectively. For example, let's say you decided to use a percentage of value approach and started off by saying, I'm going to take 5% of my pension pot, which is worth £500,000. Initially, you'd receive £25,000. Let's say the following year though, there was a 10% fall in investment values and your pot was now worth £427,500. Your withdrawal next year would be £21,375, a £3,625 reduction. It would be akin to your employer changing your base salary every year based on how much profit the company was making. That can often be the case for self-employed people, of course, but it's not a situation that most employees would be happy with. So is there another way? Well, I'm sure you're hoping so, because otherwise I've just wasted 5 minutes of your life. But thankfully there is, and we call it dynamic spending. Just before I explain how all of that works though, I've posed a question in the comments below, something that has a big impact on how long your money can last in retirement. I'd be really interested to get your understanding of this because it's something that's misunderstood by many people. So please check that question out and give me your answers. Now, I've mentioned dynamic spending in previous videos, but what actually is it? How does it work? And how can you apply it to your retirement withdrawal strategy? Well, in terms of the objective of dynamic spending, it aims to reduce the chances of running out of money while continuing to provide a stable level of income. The way that it does that is by allowing some flexibility over withdrawals to manage market shocks by setting minimum and maximum levels each year that your income can fluctuate within, following a rules-based approach. But what are these rules and where do they come from? Well, Vanguard have carried out extensive research on this, which they summarised in a research note published in March 2021. And in this, they used a ceiling of 5% and a floor of minus 2.5% to create these guide rails for annual withdrawals. That means that if the portfolio receives a positive return of 10% the previous year, the initial target income would move up by its ceiling of 5%. If the portfolio fell by 10%, the income would move down by 2.5%. I'll give some practical examples of this shortly to help clarify your understanding. So, by drawing on forecasts from their capital markets model, which provides expected return ranges for every major asset class across the world using the vast data analysis capabilities at their disposal, Vanguard concluded that a dynamic spending approach creates a higher success rate, with success defined as not running out of money during retirement, and a higher ending portfolio value than the pound plus inflation approach. The parameters Vanguard used in their research were these. They used a starting value of €800,000 because this research was performed by their European team. They assumed the money was invested in a portfolio split 60-40 between equities and fixed income. They used their own internal simulation engine, the Vanguard capital markets model, to provide the expected growth forecasts for those assets post the COVID crash in March 2020. And once they had those, they performed a Monte Carlo simulation to determine how much could be spent every year with an 85% chance of not running out of money over 30 years, with 2% inflation built in. A Monte Carlo simulation is a probability analysis. I explained it in more detail in my previous video, which I'll link below for you. What their research demonstrated was that dynamic spending allowed for a 42,400 average annual withdrawal versus a 34,400 average withdrawal from pound plus inflation. So to reiterate, taking any more than those amounts gave less than an 85% success rate. Instead of just providing that single comparison though, they provided two further ones. The first one was based on the median expected returns, but they also provided a comparison to show the results if returns were in the top 50 percentile range, i.e. an optimistic scenario, and one to show results in the bottom 50 percentile range, i.e. a pessimistic scenario. Vanguard's modelling always produces a result like this one, you see, a range of likely returns. So this would be the median, this is the top 50 percentile, this is the bottom 50 percentile. The optimistic scenario gave results of 47,200 and 39,200, and the pessimistic scenario gave results of 39,200 and 31,200. So as you can see, dynamic spending gave the ability to take more money every year on average across all of the ranges. And interestingly, even the base case dynamic spending scenario gave a better result than the optimistic pound plus inflation scenario. Amongst other things, the research also looked at the probability of your pot lasting for 30 or more years based on you taking different levels of starting withdrawal. Starting with a pot of 1 million, Vanguard calculated that your probability of success when starting off with a 30,000 annual withdrawal and increasing it by inflation was 94.6%. And if you watch my last video, you'll immediately recognise that that's remarkably similar to the findings I outlined based on a 3% withdrawal. But applying a dynamic spending strategy improves this probability to 99.5%, thus providing even more confidence. A 40,000 annual starting withdrawal gave just a 65.8% chance of success for pound plus inflation in Vanguard's modelling, but a 91.1% chance with dynamic spending. And a 50,000 annual starting withdrawal gave just a 28.7% probability of success versus 59.8%. We'll shortly move on to some practical examples of how you can actually apply this yourself. But before we do that, let's just finally look at the projected plan values at the end of 30 years. Assuming a starting level of 800,000 and assuming a 40,000 annual withdrawal, the median projected values based on the median return were 527,325 if using dynamic spending versus 275,228 if using pound plus inflation, so roughly half. This is actually a very important point because it highlights that simply looking at the probability of success doesn't tell the full story. It's only when you look at these projected values that you get this further context. Yes, the pound plus inflation strategy may have succeeded, i.e. you may not have run out of money, but the dynamic spending strategy has succeeded and left you with twice as much wealth. In the optimistic scenario, dynamic spending projects you'll be left with 817,204 versus 716,926. And in the pessimistic scenario, the figures are 299,876 and 0. In other words, pound plus inflation would fail. So how do you apply this method in practical terms then? Let's have a look at some examples. Let's say you've got a pot of £500,000 and your target is £25,000. So you need to take 5%. If inflation was 2%, which might be wishful thinking at the moment, your target in year 2 would be £25,500. If it remained at 2%, your target in year 3 would be £26,010, and so on. So if £25,500 is your target in year 2, that would be limited to a ceiling of 26,775 and a floor of 24,862. Those are the guide rails. At the start of year 1, we'll assume you've taken your £25,000 withdrawal all in one go. So you've started off with £475,000. Now let's say your portfolio achieves an 8% return. At the start of year 2, it would then be worth £513,000. So you apply the same 5% withdrawal to the value of your pot, and this gives you £25,650. As this is within the guide rails, you can withdraw that full £25,650 in the second year. In scenario 2, we'll assume that your portfolio actually falls in value over the first year by 4%. So by the start of year 2, it's worth £456,000. Applying the 5% withdrawal to that value gives a figure of £22,800, which is below the floor level. So in the second year, you take the floor income of £24,862. Finally, in scenario 3, we'll assume your portfolio increases by 20% over the year. So your value has shot up to £570,000. 5% of that is £28,500, which is above the ceiling. So in year 2, you take £26,775. All you simply do is rinse and repeat that same process every year, altering the previous year's base income target by the appropriate level of inflation. So we discussed in my last video how to identify an initial withdrawal amount that has a high chance of success when using a pound plus inflation strategy. But building on that, dynamic spending aims to do two things. Further safeguard your capital in a downturn, but increase your levels of withdrawal long term. If you haven't watched my previous video yet, here it is now, or if you have, feel free to go back and watch it for a refresher now that you've got this added knowledge. As always, I hope that's been helpful, and I'll see you again soon.